Holy, I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, I just got a terrifying text from one of my friends who's an insider. He said the Fed is making a huge mistake here, and all the evidence is in the labor market indicators. And what he had to say was what's happening in the stock market right now is not seasonal, has nothing to do with the election. He said what we're about to face is economic hell to a level we have not seen since the global financial crisis. And as you're about to see when we look at the data, things are going to get far worse than they are today. Now, let's head over to Bloomberg, where we picked today's story up with a headline: as stocks sink as jobs fuel bet that the Fed is behind the curve. And not only are they behind the curve, as you're about to see by the data, they are always behind the curve. And one of the issues here is before this FOMC meeting, which capped off on Wednesday, there's a good chance the Fed had a hint from the Bureau of Labor Statistics what the non-farm payroll numbers were going to look like. So the decision they made was based on the data you're about to see, and it points to the Fed being behind the curve in a major way. Equities tumbled at early U.S. trading after data showed U.S. hiring slowed by more than forecast in July, and the unemployment rate rose to the highest level in nearly 3 years, suggesting the labor market is cooling faster than the other data suggests. But we already knew this was happening. Now, one of the problems here is Fed Chair Jerome Powell has said that he believed the peak in the unemployment rate was right around 4.1%. Well, it went above that, and I'm going to show you why it's headed a whole lot higher, and by the time the Fed reacts in September, it's going to be far too late. A tumble in key technology companies also added fuel to the equity rout. A rally in treasuries extended into a 7th straight day, which is a sign that financial conditions are tightening and tightening rapidly. This is the biggest red flag. It's not the equity market selling off, it's what the bond market is doing, and I'll show you why. The price action underscores how quickly sentiment has shifted away from expectations that the Federal Reserve will be able to engineer a soft landing for the economy. And this is something that investors have been buying up stocks for months, under the belief that all it would take is 1 or 2 cuts because the Fed was going to nail this Goldilocks perfect soft landing, something that throughout history of the Federal Reserve, or any central bank for that matter, has never been done. But this time, investors front-run the Fed in a huge way, only to find out that perhaps the Fed is making one of the biggest mistakes they've ever made in the history of the Fed. And here we can see the Fed Chair Jerome Powell's acknowledgement of the weakening data this week has lent strength to bets that the central bank would need to cut policy rates 3 times by the year end. Now keep in mind, the Fed is only looking at potentially 1, but the market is now saying, no, we're not going to have 1, we're going to have 3, and I'm going to show you why it may be even more than that. The rush for Treasury sent the 10-year yield below 4% this week for the first time since February, marking a huge red flag, but something that is rising. Well, that would be trading account. Let me show you some trades we're stopped out on our CTA Timer Pro. Locked in 11.22% gain on our trade on ITB. And how do we do that? Every day we look at the machine positioning, and when they get into deep short position, and mind you, this is going to happen soon. We're already seeing this in the data. The sell-off is a gold mine for our subscribers, and they're getting very excited because when this reversal hits, we're going to note that when machines are deep short and price goes against them, it's going to flag a ton of buy signals, and you can be a part of that. How about our Momentum Timer Pro report? We just locked in a 1.9% trade on the Dow, certainly beating, of course, the S&P and the NASDAQ by a mile. That is on the books today. And how do we trade momentum? Well, a lot of people just trade these indicators, but we aggregate them together with a proprietary overlay, and we look at it over multiple time periods. So when we see large pullbacks, particularly over a 1 month or 3 month period, a report flags that and gives us the signal. And here's the best part. You get the daily reports. I give you all the signals. You can pick from them. I give you my opinions on which ones I think you should look at and do. We We give you the stop loss levels. We track our trades and returns so you can duplicate every one of them to the penny. We give you a weekly update on our stop loss levels. And here's the best part. As this market sells off, it's going to be a huge opportunity for you to make money. You can get it now with a 30-day free trial because things with the equity market and the U.S. economy are set to get far worse in the near future. As the U.S. unemployment rate rises again, as now we take a look at the labor market data that my friend said we needed to focus on for what the path is for the U.S. economy, because this is going to cement a Fed rate cut by September. And of course, we know if it gets far worse, which I know the data is going to look worse by the time we get to September, but probably not enough for the Fed to do an emergency cut. They will likely wait until September, but in the means after that, look for far more cuts than 3. As non-farm payrolls rose by 114,000 last month, missing all expectations after downward revisions to the prior 2 months sent, of course, demand for labor going down. And that was lower than all but one forecast in a Bloomberg survey economist and one of the weakest prints since the pandemic. But this was no surprise to us, and I'll show you why. But here's the bigger issue. It's not that there are fewer jobs created. Its average hourly earnings also came in below forecast, and that's a huge sign that demand for labor is declining, because when earnings fall, it means employers do not feel pressured to give out as big of wage gains, meaning they don't have the business for it. It also means they know there's an ample workforce starting to line up in the unemployment line, giving them options in case people don't want to stay. And the unemployment rate unexpected climbed for a fourth month to 4.3%, but not to us. We knew this was going to happen. I'll show you why. That reflected more people losing and leaving their jobs rather than new workers entering the labor force. And that is a big problem, as we noted on Thursday. But let's take a look at the unemployment rate, because this is something the Fed Chair Powell should peak right around 4.1%. It's now at 4.3. And I want to show you why the weekly continued unemployment claims data is probably right now the most important data series to look at over anything, because it tells you exactly where all the government data is going to follow with a lag. So let's take a look here, because we have the unemployment rate in red against continued unemployment claims in blue. And what do we know? That where continued claims go, the unemployment rate follows with a lag every time, except this 1 point right here, kind of in the late 70s. But you'll notice here in the early 90s, that's what happened going into the dot-com bubble. The global financial crisis, claims started to rise, and then the unemployment rate followed. And surprisingly to experts, that unemployment rate's going up. But if you've been following the continued claims, you knew it was only a matter of time. And if we take a look at the non-farm payroll report, now I've cut off the period right before the pandemic so we can look at the data, because when we have the pandemic data, it skews the chart where you can't see it. But I want you to understand that when we look at the unemployment rate and why this is a good leading indicator of the non-farm payroll report is because it tells us everything. And here you can see the unemployment rate in red rising against a declining and then eventually contracting non-farm payroll report. And you can see this relationship happens each and every time. And so why this is critical to understand is because what we know is when continued unemployment claims go up, then what happens is the unemployment rate with a lag goes up. And what follows that is a non-farm payroll report going down. And while we're talking about things looking down, check out the description below to grab that 30-day free trial for our reports. Remember, when this correction reverses, it's going to be a huge gain as market participants jump back in and buy the dip. But look at this. You continue to see the relationship here. Unemployment rate rises, and then what happens? Non-farm payroll report with a lag follows. So today's report was absolutely no surprise to us. The jobs report adds to a week of disappointing data that raised concerns of a more abrupt downshift to the economy. And this is something that many people did not believe would happen. Again, they were buying into the soft landing or no landing scenario. And all of a sudden, there was this huge shift in sentiment to suggest that maybe the Fed screwed this up, because the Fed said it would be a second half rebound. Well, here we are in August, and it doesn't look like a second half rebound at all. It looks like everything's continuing to decelerate at a fairly good clip. And this has prompted a stock market sell-off and pushing down treasury yields, indicating that financial conditions are indeed tightening here. The figures may give Fed officials some reason to believe that their policies are cooling the labor market too much rather than reverting to its healthy pre-pandemic trend. The problem we have is the next Fed meeting isn't until September. And by then, we're going to have a whole lot more data to look at. More importantly, the weekly continued unemployment claims data is going to be critical. Now, many people believe as we head into the back-to-school season that number is going to go down. But if it doesn't, watch out. Because as we look at what the Fed does, they're always late to the party. Here we can look at the unemployment rate in red, and we can see again, this is just a lagging effect of continued claims. So as, of course, we see unemployment rate rise, you'll notice here back in the late 80s, the Fed was actually fairly on top of this, cutting rates as the unemployment rate rose. But as time passed and the FOMC board evolved and their views evolved, what you see now going to the dot-com bubble is the unemployment rate continued to rise, and then the Fed reacted too late. And how about the global financial crisis? The Fed was late to that party as well. Of course, the pandemic, for some reason going into the pandemic, the Fed was cutting when the unemployment rate wasn't rising. I'll show you what the real reason for that is. And here you can see again, the unemployment rate rising, and the Fed is quiet, at least until September, when we can likely expect a 0.25% rate cut. But we know, of course, it won't make absolutely any difference, because when we look back on that chart, there's one bit of evidence we can see. You'll notice the Fed rate cuts did nothing to stop the trend of the economy. Not once did it change the trajectory of the labor market. In this case, going into the pandemic, it did help a little bit, actually push the unemployment rate down. But by the time the pandemic hit, it was way too late. But what does the Fed actually care about, and why are these reporters talking about interest rates? Because yields are everything. We take a look at the federal funds rate in blue against two-year treasury yields, and we can see the two-year yields shown in red lead the funds rate shown in blue each and every time. Now, the Fed has ignored two-year yields not just once, but twice this cycle. This time, they're likely to pay attention, because if two-year yields continue a downward slide into September's meeting, it means a 0.25% cut is baked in the cake, because the Fed will not continue to ignore the market. But of course, by that time, it also means the financial conditions will further tighten and more people are likely to be on the unemployment line. And while the Fed does have a fixation with inflation, it has come largely down from its pandemic peak, Powell said, and officials are now more focused on the other side of their dual mandate, which is the labor market, because they don't want to prevent any damage. But the problem is it's already happening. And that's why I wanted you to see the unemployment rate against the federal funds rate, because by the time the Fed reacts, it's too late. Demand from the economy has dropped enough, and it starts to spiral out of control. As more workers hit the unemployment line, their incomes get cut, their spending gets cut, and they have no opportunities to re-enter the workforce out of ways that they would like to have, which means next thing you know, it just creates a feedback loop where a lack of demand leads to more workers hitting the unemployment line. And by the time the Fed gets around to cutting rates a couple of times, it has absolutely no effect on the economy. We've had this really significant decline in inflation, and unemployment has remained low, Powell said. But what we're thinking about all the time is, how do we keep this going? Well, the problem is it's too little too late, Mr. Fed Chief. Your track record at your department, under not just your guidance and leadership, but everyone before you, has had a perfect 100% failure rate. And this time we expect absolutely no difference. Because we know consumer prices are going to come down by September, because the unemployment rate tells us. And this all comes back to the fact that if people are on unemployment, earning less income, they have to spend less. It's just how it goes. Sure, they can run up their credit cards in the short term, but when the reality sets in that there isn't another job, spending drops in a big way, and that means inflation comes down. And you can see the relationship here between the consumer price index shown in blue against the unemployment rate, that's shown in red. And as we see the unemployment rate rise, well, what it means is inflation comes down. And this happens each and every time. Sometimes there's a little bit of a lag between the two, too, but the relationship is solid. Where the unemployment rate goes, the consumer price index falls. The problem is it happens with a lag now as we move forward into more modern times, where it takes a bit of an increase in the unemployment rate for a reaction in the consumer price index, suggesting that by the time the Fed realizes that consumer prices are heading back to their 2% target, as I've made the claim and I'll stand by it, we're going to overshoot the 2% target to the downside, and at that point it's game over for the Fed. They can cut all they want, but as you've already seen, it means the labor market is going to continue to unwind and take inflation with it. And the slowdown in payrolls reflected cuts in information and car manufacturing. Temporary help, which is a big indicator, also declined, which is often looked as a precursor to a downturn. And this is true when employers stop needing temporary help. It means they're looking to lay off some of their permanent workers. And so this is a huge red flag. Meantime, healthcare continued to lead job growth. But here is one of those big indicators, the SOM rule, employment and recession indicators. You know, we go back to that text message I got earlier today, and it said, look at the labor market indicators. Well, we're looking at those, but here's the big one from the Fed itself. It's called the SOM indicator, and economist Claudia Sahm developed a SOM rule, which states the economy is in a recession when the unemployment rate's 3-month average is half a percentage point above its 12-month low. And so let's take a look at a chart of that, because here we have the unemployment rate in red against the real-time SOM rule recession indicator, and have drawn a green line over that 0.5% value above the last 12 months of the SOM rule indicator. And what it says is we are indeed now in a recession. And you can look back here to how the signal worked going into the late early 80s. That is, you can see it nailed the recession each and every time. And all we have to do is look at continued unemployment claims, and we already knew this was happening. Now we have confirmation, not just according to a broad view of the labor market indicators, but the SOM rule now saying we are indeed in a recession. And this is bad news for the equity market, which is why my friend said what's happening with stocks is not seasonal. It's not election based. It's something far worse, as we now see the NASDAQ 100 in correction territory, where the AI darlings are sinking like lead balloons. And this is amazing about face, like we've crashed into a brick wall. Something that we've talked about will eventually happen, because when financial conditions tighten and banks constrict the creation of credit, there eventually isn't enough money to sustain the value of the equity markets or asset prices to begin with. This is why every time the central banks do this, and we have a bubble from the prior move of easing, that the bubble bursts because there isn't enough money to keep it going. The only way to keep it going is to continue to inject money and inflate the bubble. But the moment you pull back, it pops. And now it's looking like the stock market bubble is popping as well. We had a heck of a straight line up as everyone continued to buy the narrative that the U.S. economy was going to engineer the very first soft landing in history and go booming from there. But they don't last forever, especially since expectations got so high. You clearly can't just own technology. You need some exposure to the more defensive areas. And the problem is we have a bubble in the top 5 U.S. stocks of these major industries, where more investors are crammed into 5 stocks than any time in history. And not by a little bit, by a long shot. And red flags have been waving for the better part of the year, whether it's tech stocks are too expensive as AI-fueled gains are overdone, or that the market is too concentrated. Well, the issue is both. With some high-profile earnings disappointments, many of those views, investors are now heeding those warnings, pocketing gains and plowing into previous laggards like utilities, which actually won't work, which have been leading the market over the past 2 sessions as Treasury is tumbling, leaving traders to bet on the Federal Reserve cutting interest rates at its next meeting in September. But the reality is what Treasury yields are saying is financial conditions are tightening. And for the equity market, well, let's go back to the continued unemployment claims, because what the labor market is telling us here, when people hit the unemployment line, keep in mind, they don't fund their 401ks anymore. They don't have any income to fund their IRAs either. And many times, if they have a lot of debt and a lot of bills, particularly in a high interest rate environment, well, they typically cash their money in to make sure they can keep food on the table and a roof over their head and a car in the driveway. And that's why we tend to see major sell-offs in the equity market. We can go back here to see why as we look at continued claims rising into the dot-com bubble and what happened. The NASDAQ 100 completely puked in a major way. It happened again in the global financial crisis. This time people said not going to happen. We could see layoffs, and that's bullish for stocks. Well, the problem is they don't remember how the system works. Here we're seeing a rise in continued claims, and now the stock market is running out of steam after investors have bid this up in a crazy way to valuations completely unsustainable. But as this bubble pops, as the labor market unwinds, as we're about to find out, economic hell is here and it's going to get a whole lot worse. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.